Welcome to the Deep Dive, brought to you by BookCast FM.
Bringing books to life, one cast at a time.
Today, we're tackling a real giant in the investment world, Philip Fisher, and his, absolutely foundational book, Common Stocks and Uncommon Profits.
It's a classic for a reason. Famously recommended by Warren Buffett, shifted how people thought about investing.
Totally. And it's not just about the numbers, is it? It's about digging deep, into the soul of a business.
Exactly. That's the core.
So our mission today, using excerpts from a summary of this classic, is basically to give you the inside track on Fisher's unique approach. How did he spot those companies with the potential for uncommon profits?
What was he actually looking for? And maybe how can you start thinking a bit more like him?
Yeah, think of this deep dive as your shortcut to seeing companies through Fisher's eyes. Less like, lines on a spreadsheet.
And more like living things, right? With potential or maybe hidden problems.
Okay, let's unpack this. Published way back in 1958. That's a while ago. But this was seminal stuff for long-term growth investing.
Oh, absolutely. Before growth investing was even really a codified term, you could argue, his genius was focusing on a company's potential for, sustainable growth decades out.
He wasn't trying to time the market or trade headlines.
Nope. And his method, it prioritized qualitative research. He has a great term for it, scuttlebutt.
Scuttlebutt. Sounds a bit old-fashioned, maybe.
It does, but it's essentially detective work, going beyond the official story.
Okay, so his core idea was that great investments come from understanding the business fundamentals. And by fundamentals, he meant things like management quality, innovation.
Right. The people running the show, their ability to innovate consistently, and the real potential for profit growth, not just, last quarter's earnings per share.
Which is where he diverges quite a bit from, say, Benjamin Graham, the value investing guru.
Big time. Graham was more about finding assets on the cheap based on the balance sheet, buying that dollar for 50 cents. Fisher, he was different.
How so?
He was willing to pay what might seem like a premium price now. If he truly believed the company's future growth prospects were strong enough to make that price look like a bargain down the road.
So it's about the long game. Building serious wealth over time by owning these great businesses he really understood. Getting that compounding magic working for you.
Exactly. And he built a framework for it. You mentioned the 15 points, the scuttlebutt method.
Right, and focusing long-term, avoiding the herd, knowing the difference between investing and speculating, and, crucially, management quality. Those are the pillars we need to get into.
Absolutely.
So let's jump right into maybe his most distinctive idea, the one that really sets him apart. From Chapter 2 of the summary, the Scuttlebutt method.
This is where the detective hat comes on. Fisher got that, financial statements, annual reports. They're important, sure, but they only tell part of the story, often the backward-looking part.
Right. To really get what's happening now and what might happen next, you need to get out there.
Yeah, like a journalist or, like you said, a detective, talk to people.
And he was specific about who to talk to, wasn't he? It wasn't just calling up investor relations.
No way. He said talk to the people who actually deal with the company. Customers, suppliers, even competitors.
Competitors, really?
Yeah. And former employees, industry experts, anyone who might have a real-world perspective.
You're trying to uncover stuff that's not in the glossy report, right?
Right.
Like, how strong are their customer relationships really? Are they actually innovating? What's their reputation?
Exactly. Are they respected, feared, ignored? That kind of ground-level insight is gold.
But you got to be careful, right? A competitor might not give you the straight story, or a disgruntled former employee.
Absolutely critical point. It's not about taking any single person's word as gospel. It's about gathering lots of viewpoints, cross-checking, looking for patterns.
Filtering the noise to find the signal.
You got it. And the key thing here for you, the listener, is that you can actually do some version of this. Ask smart questions to people who might have those non-public insights. Triangulate. It takes work, sure.
But that's the edge, maybe. Doing what others aren't willing to do.
Precisely. He gave a great example, like talking to the companies that sell equipment to a manufacturer you're researching.
Oh, interesting. Why?
Well, are they buying the latest, most efficient machines? Are they investing in the future? That tells you a lot about management's mindset, their commitment to staying ahead. Stuff that's hard to see just from depreciation numbers.
That makes total sense. It highlights that, quote, the business grapevine is a remarkable thing.
It really is. He felt, and I'm paraphrasing here, that you could get more useful investment info from it than almost anywhere else. Like, it is amazing what potentially valuable investment data can be obtained just by asking good questions.
And that scuttlebutt process, that feeds right into the next big piece.
Directly into the heart of it all. The 15 points from Chapter 3. This is his checklist, his filter for finding those truly exceptional companies. It's way more about the quality of the business than just valuation ratios.
Okay, so maybe instead of just listing all 15, we can group them. What kind of questions was he asking?
Good idea. Broadly, he looked at a few key areas. First, growth and innovation. Things like, does this company have potential for a sizable sales increase? Is the market big enough?
Not just a niche product.
Right. And is management determined to keep developing new products? Like, is there an ongoing growth mindset, not just resting on laurels?
And is their R&D actually effective? Not just spending money, but getting results. Profitable innovation.
Crucial. And do they have the sales team to get it out there? And point 5 was vital. A worthwhile profit margin. He was blunt about it. If a company does not have an adequate profit margin, it is not going to be an outstanding investment. Strong margins show efficiency, pricing power.
Okay, so growth, innovation, margins. What's next?
Then he dives into operations, management, efficiency. Can they keep those margins or even improve them? Through cost control, how are their labor relations?
Happy employees or productive employees?
Often, yeah. And innovative, too. Are the top executives working well together? Is there a cohesive team?
And this is a big one I remember. Management depth.
Huge. Is there a bench? A succession plan? Or is it all reliant on one-star CEO? Durability matters. And finally, controls. Do they actually know their costs? Good accounting, good controls. It's like the company's nervous system.
Makes sense. It ensures the company isn't just a temporary success, it has staying power. What about the last group of points?
That covers things like competitive strength, how they treat shareholders, and that absolutely critical element, integrity.
Okay.
He asked about the trade-off between short-term profits and long-term investment. Fisher loved companies willing to invest for the future, even if it meant lower earnings now. He was skeptical of managers obsessed with just hitting the next quarterly number.
Right, sacrificing the future for today.
Yeah. And is their growth funded responsibly? Or are they constantly issuing new stock, diluting existing owners just to get bigger? That's not always good for shareholders. Transparency was key, too. Are they open, especially when things aren't going perfectly?
And point 14, you said integrity.
The cornerstone. Unquestionable integrity. He basically said, dishonesty at the top can wreck more value than almost anything else. You just can't compromise on that.
Wow.
And finally, are they really aligned with shareholders? Is executive pay reasonable? Are they allocating capital smartly to benefit the owners, not just build personal empires? Taken together, these 15 points give you such a rich, holistic picture.
Way beyond just an income statement. It's about the quality, the character.
Exactly, the whole package. And it ties into how he thought about selling, too. There's that great quote in the summary about holding on to stocks just because they're too cheap to sell.
Yeah. More money has been lost by investors holding a stock they really did not want because it was too cheap to sell than from any other single reason.
It hammers home that idea of getting the buy decision right by focusing intensely on quality first.
Which leads us nicely into Chapter 4.
Yeah.
Actually applying these ideas and, importantly, avoiding some common mistakes.
Right. And Fisher was realistic. He knew maybe not everyone has the time or resources for exhaustive scuttlebutt on every single idea.
So you tailor it.
Yeah, tailor it to your own situation, your temperament, know your limits. Maybe you rely on trusted professionals who do follow this kind of rigorous process if you can't do it all yourself.
He also keeps hitting that difference between investing and speculating.
Constantly. Echoing Graham, really.
Yeah.
An investment needs thorough analysis, promises safety of principle, and a satisfactory return over the long haul. It's not about guessing market wiggles.
And he wasn't big on over-diversification, was he? Kind of famously so.
Not at all. He thought spreading yourself too thin meant you couldn't possibly know enough about any single company. Mediocrity through diversification, essentially.
He preferred a focused portfolio.
A concentrated portfolio of companies he knew inside and out. That quote is punchy. More money has been lost through weak diversification than through the concentration of good investments. Puts it bluntly.
Challenges the standard advice, for sure. He also suggested building positions slowly, not going all in at once.
Yeah, accumulate gradually. Maybe buy more on dips if the fundamentals haven't changed, and definitely don't get shaken out by temporary price drops if the business itself is still strong, which links back to that almost never sell idea for the right stocks.
Okay, so speaking of buying and selling, chapters 5 and 6 dive into timing. When do you buy, according to Fisher? And when, if ever, do you sell?
Well, for Fisher, buying was driven by the business, not the market forecast. You buy when the company checks the boxes, meets those 15 points.
Not just because the S&P 500 looks cheap.
Exactly. But price still matters somewhat. You need a reasonable price relative to the long-term potential. He wasn't looking for deep bargains necessarily, but he cautioned against getting so hung up on nailing the absolute bottom price that you miss owning a great company altogether.
Reasonable, not perfect.
Right. And this is where Scuttlebutt helps again. If some temporary bad news hits a great company, and your research tells you the fundamentals are still solid, that can be a fantastic buying opportunity.
Because the market overreacts.
Often. And he was really against traditional market timing, trying to predict corrections. He thought that cost investors far more money than the corrections themselves.
So instead, use pessimism as an opportunity. Buy gradually when others are fearful.
If your research supports it, yes, accumulate.
Okay, now the flip side, the famous part. When to sell. You said almost never.
That's the headline message, definitely. If you've done the work, bought a truly outstanding business with a long growth runway, the real money, the uncommon profits, come from holding on for years, decades even. Selling kills the compounding.
But there are times to sell. It's not literally never.
No. He outlined 3 legitimate reasons. 1, the fundamentals genuinely deteriorate. The company just doesn't meet your 15-point standard anymore. Management changed for the worse. Competition crushed them. Innovation dried up. Something core broke.
Okay, makes sense.
2, you realize you made a mistake in your initial assessment. You learned something new that shows the company wasn't as great as you thought. And he stressed, no shame in being wrong, only in failing to fix it. There is no shame in being wrong, only in failing to correct your mistake.
Own your mistakes. And the third reason.
This one should be rare. You find a clearly superior investment opportunity, something so compelling it justifies selling even a good company to make the switch. But the bar should be very high.
And what are the wrong reasons to sell?
The big ones are the stock price has just gone up a lot, or the overall market is falling.
Selling winners too early.
He had that great analogy. Selling a great stock just because it went up is like cutting down a tall tree because you wanted shade. You destroy the very thing providing the future benefit.
Huh. That's good. And selling in a panic just locks in losses.
Right, and prevents you from benefiting when things recover. His point was, it is much easier to identify a great company than to accurately predict market highs or lows. Focus on the business, have conviction, be patient.
Speaking of conviction and maybe unconventional views, let's touch on dividends. Chapter 7. People love dividends.
They do, but Fisher challenged that obsession, especially for growth investors. He argued that a company's ability to wisely reinvest its profits back into the business, that's often far more valuable long-term than just paying out cash.
So a high dividend isn't necessarily a sign of a great company.
Not in his view. Financial strength comes from generating profits and using them smartly. His quote was something like, investors should be far more concerned with the ability of a company to grow earnings than with whether it pays a dividend.
Because if they have great growth opportunities, R&D, expansion, that reinvested money could compound at a much higher rate.
Exactly. Higher returns than you'd likely get from the cash dividend yourself. Plus, there are tax advantages often to capital gains over dividends for long-term holders.
He even saw high dividends as a potential negative sometimes.
Yeah, like maybe it signals the company lacks good growth opportunities. Why else are they giving all the cash back? It could signal stagnation.
So dividends make sense mainly for mature companies with fewer places to reinvest.
Pretty much. The policy should fit the company's stage. So the actionable point for you is, don't screen only for high yield. Look at how they're reinvesting earnings. Is it generating good returns on capital? That's more important than the payout ratio itself.
His take. The best dividend a good company can pay is not a check, but the increasing value of the stock itself. Powerful.
It is.
Okay. He also gave some very clear warnings in chapters 8 and 9, a list of don'ts, basically behavioral traps to avoid.
These are fantastic, still so relevant. Like, don't buy into promotional companies, all hype, weak substance. Don't ignore a good company just because it's traded somewhere less obvious, like OTC back then, maybe smaller exchanges today. Focus on quality, not the listing venue.
And this one's great. Don't buy just because you like the tone of the annual report.
Ha, yes, it's marketing. The polish of a report is no substitute for the substance of a company. Look deeper.
Also, don't assume a good company is automatically a good buy. Price still matters, needs to be reasonable relative to the future, and don't sweat the small price differences. Over a span of years, the difference between buying at 35 or at 35 and a quarter R is meaningless. Focus long term.
He also doubled down on diversification again in the don'ts. Don't overstress it. More money has been lost through weak diversification. We heard that one. Don't dilute your best ideas.
And this feels very relevant now. Don't be afraid of buying during a crisis, a war, or a scare.
Huge. Those times often punish great companies along with the bad. When everyone is selling in fear, it may be the best time to buy in reason, if your research holds up.
Don't blindly follow experts either. That was his quirky, don't forget your Gilbert and Sullivan point, right? Think for yourself.
Trust your own analysis. Authority isn't always right. Also, remember that time is crucial. Great companies need time to work their magic. Patience. And the big one, don't follow the crowd.
Independent thinking is key. The truly great investor is rarely popular at the time he's making his best buys. So these don'ts are like mental guardrails.
Exactly. Ignore hype. Focus on substance. Don't be a perfectionist on entry price. Use fear rationally. Think independently. Be patient.
Which brings us logically to Chapter 10. How did Fisher actually do it? His step-by-step process.
It pulls it all together. Step 1. Start with Scuttlebutt. Tap that network industry contacts, execs, suppliers, customers. Get word-of-mouth leads first. Talk to maybe 5-10 people to triangulate before hitting the books.
So grapevine first, then public data.
Yes. Use annual reports, filings, etc. after the informal checks. Not to find bargains, but to verify and deepen the understanding of a company already flagged as interesting by the Scuttlebutt.
Got it. Then step 3 is running it through the 15 points.
Rigorously. Applying that checklist as a filter. Knowing no company's perfect, but looking for strength across the most important points for that specific business.
And he really valued meeting management face-to-face if possible.
Immensely. To assess them directly. Observe their demeanor. How willing are they to answer tough questions? He noted, what a company says about itself is far less revealing than how it behaves when asked difficult or uncomfortable questions.
And crucially, be willing to walk away.
Absolutely. If management is evasive, if the company doesn't seem truly exceptional, if you can't get clear answers, just say no. Discipline and rejecting most ideas is key to finding the few great ones.
And if it passes all that, don't rush in.
Nope. Buy slowly, accumulate gradually, maybe adding more on weakness, build your conviction, then build your position. It's a patient process.
It really underscores his comment about judging people, management being one of the most vital skills.
It truly is central to his whole approach.
And that focus on quality and people flows right into part 2 of this summary, redefining what a conservative investment really is.
This is such a powerful reframing. For Fisher, conservatism wasn't about low volatility or owning supposedly safe but maybe stagnant things. True conservatism was rooted in the long-term safety and reliability of a superior business.
It's about the underlying business strength, its resilience, its predictable growth potential, not just short-term stock wiggles.
Exactly, and he broke it down into 4 dimensions. First, operational superiority. Is the company excellent at its core functions? Efficient production, smart marketing, effective R&D, sound financial skills.
Getting the basics right exceptionally well.
Yes. No company is ever truly safe unless it excels in the core functions, as he put it. Second dimension. People. We've hit this hard. Management integrity, competence, judgment, depth, positive culture, good employee relations.
All those leading indicators of quality.
Right. More than any statistic, the quality of the people will determine the quality of the investment. Third dimension, investment policies. How do they use their money? Reinvestment, dividends, buybacks, M&A. Do these decisions truly build long-term value?
Or are they just building empires for ego?
Beware the empire builders. Growth that doesn't improve the quality of earnings is not growth, it's distraction. You want smart, conservative, but not passive capital use, financial flexibility. He said you learn more by watching how they use money than by reading their PR.
Look at the actions, not just the words. And the fourth dimension.
Price. Yes, even a great business can be a bad investment if you pay way too much. But again, Fisher wasn't just chasing low PE ratios. Value comes from future earnings power, competitive strength, scalability.
So don't overpay, but don't miss a potential lifetime compounder waiting for the absolute perfect price either.
That's the tension. There is nothing conservative about waiting for the perfect price and missing a lifetime compounder. Use price as a filter, be reasonable, but if the other three dimensions, operations, people, policies, are truly outstanding.
That provides the real margin of safety.
Exactly. Buying a great company at a fair price is infinitely safer than buying a fair company at a great price when all four dimensions align. That's conservatism, Fisher style. You can sleep well then.
Part 3 of the summary shifts a bit, talking about developing your own investment philosophy.
Yeah, and Fisher was clear. His approach wasn't something he was born with. It came from curiosity, discipline, and crucially, learning from mistakes. Self-education was key.
He was open about messing up.
Very. Analyzing mistakes was how he learned. Success in investing doesn't come from being right all the time. It comes from recognizing when you're wrong and acting quickly. That builds adaptability, humility. The market definitely punishes pride.
The best investors correct course quickly and never stop improving their judgment. Experience builds that intuition, that ability to read softer signals.
And his philosophy matured into that disciplined long-term focus, the anchor. Remember, the big money is not in the buying or the selling, but in the waiting. Depth over breadth, process over prediction, sell rarely, filter the noise.
It becomes a practice, not just a theory. A sound investment philosophy is not a theory, it's a practice, forged over time through study, mistakes, and conviction.
Sums it up well. So the core principles to take away. Focus on outstanding companies. Do deep qualitative homework like Scuttlebutt. Think long-term. Avoid the common behavioral traps. Use his tools like the 15 points to build your own approach.
Treat stocks like owning part of a real business. Let winners run. Stay humble. Keep learning.
Now that final quote is just perfect. If you want uncommon profits, you must do what others are unwilling to. Understand more, wait longer, and act less.
Wow. So, thinking about applying all this,
Yeah.
for you listening, it really starts with curiosity, doesn't it? Asking better questions, looking beyond the surface.
Patience, too. And that independent thinking, seeing businesses as these complex living things, not just tickers.
And Fisher really hammered home temperament, discipline,
Yeah.
alongside the analysis, building your personal philosophy through experience, learning from errors.
Yeah. Which leads to maybe our final thought for you to chew on. Fisher showed the deep dive isn't just into companies. Maybe the deepest dive is into yourself. Understanding your own biases, your patience level, your tolerance for noise is building that internal operating system the most critical step.
That's a great question to ponder. Is mastering yourself the key to mastering Fisher's approach?
Could be something to think about.
Well, that wraps up our deep dive into Philip A. Fisher's incredibly influential Common Stocks and Uncommon Profits. That focus on quality, patience, and deep understanding is just so powerful for long-term success.
We hope this discussion gave you some valuable insights, maybe a few aha moments from exploring how a master investor thought.
This has been The Deep Dive from BookCast FM.
Bringing books to life one cast at a time. Now, we've covered the highlights based on the summary excerpts, but to really get the full depth of Fisher's wisdom,
You really should check out the full book. It's worth a read. Supporting the author by buying the book is a great way to continue learning. You'll find a link in the description.
definitely recommended.
Thanks so much for joining us for this deep dive.
Until next time.